In every other bull market you could ever point to or remember, Wall Street has thrived. The securities industry has kind of gone to new heights, become more profitable, found new ways to make money. That's not the case this time. Just look at a chart of Goldman Sachs shares and Morgan Stanley compared to the S&P 500. I dated this to the top of the previous bull market in 2007. So basically, this kind of takes away the effect of how depressed these stocks were at the crisis in 2009. The white line is the S&P 500. You see that up 84% from the previous bull market high. Goldman Sachs basically flat, up 4%. Morgan Stanley down 29%. That's just an emblem of it. Of course, Wall Street is smaller, less lucrative in a lot of different ways, less lucrative for employees, too. So if you look at Goldman Sachs compensation, this is salary and benefits per employee. Total compensation divided by the number of employees. In 2007, you were at $660,000. Now you're at about half that, $323,000. So obviously, these firms have had to become leaner. It's mostly because the crisis and the aftermath accelerated a lot of trends that were already going on, disrupting the industry of securities brokerage, institutional sales, investment banking, and all the rest of it. You've had automation that's swept over all of these industries. Obviously, regulation as well. There's just less leverage. These banks can't really trade as much as they did. Obviously, you have the Volcker rule and things like that. And then just the move toward indexing and lower cost investing techniques. Nobody wants to pay commissions. Nobody wants to pay for research. All this stuff is really hollowing out Wall Street. Now, if you do look, guys, at the retail side of things, the Charles Schwabs of the world, the BlackRocks, they've done very well because they're just kind of these scale players. It's mostly software. It's mostly basically just by providing cheap access to the markets.